So this module sets the foundation for how institutional investors think about sectors in the lower middle market. Sector selection is not a secondary decision. It is one of the primary drivers of returns in the LMM private equity. Importantly, value creation in this segment is not macro driven, it is operational. Not every fragmented or growing sector is investable because fragmentation alone does not equal opportunity. The real objective is choosing sectors where value creation is controllable, repeatable, and driven by execution rather than external tailwinds. So institutional investors look for very specific characteristics when evaluating LMM sectors. Attractive fragmentation is usually driven by underinvestment, not regulation or structural barriers, right? Recurring or repeat demand creates predictability and underwriting confidence. So unit economics should be improving with professionalization, meaning when you have better systems and processes, they actually unlock margin. So critically, customers should value reliability and execution over pure scale, which creates defensibility when you have well-run operators. So you'll also notice that capital efficiency is disproportionately important in the lower middle market. Asset-light models that have low maintenance capex preserve early cash flow and they reduce the execution risk, right? Growth should be sequenced, not forced, without requiring heavy upfront reinvestment. The strongest models convert incremental revenue efficiently into EBITDA. So this allows for faster execution, cleaner scaling, and ultimately higher IRR velocity during the hold period of the private equity investment. So fragmentation only creates value when it is fixable. So in many LMM sectors, subscale operators lack the systems or the processes and the discipline, not the demand. So scale then unlocks shared services, pricing consistency, and operating leverage. Professionalization becomes a competitive advantage, not overhead. And when all of this is done correctly, consolidation supports both the EBITDA growth and multiple expansion, but only in the right sectors. So let's just remember, some risks just cannot be fixed, no matter how good the execution is. Heavy regulation can change the rules overnight and hurt margins. Capital-intensive businesses tie up the cash and limit flexibility. And highly cyclical industries can just simply wipe out progress during downturns. And if performance depends more on the external factors than execution, returns become unpredictable. So at the sector level, the goal is very simple. Avoid areas where success is outside of your control. So to wrap up this discussion, the key takeaway is that sector selection defines the playing field in the lower middle market. Choosing the right sectors determines whether operational execution can actually drive the returns. In the LMM, attractive outcomes come from sectors where investors can control the results, not react to macro forces. So in the next module, we're going to be shifting from what to buy to how to find it, focusing on deal origination and sourcing strategy, including how institutional investors build pipelines, prioritize proprietary relationships, and allocate the time between volume and precision.